As Ben Franklin said, taxes will always be with us. And let's talk about Arizona real estate taxes. They have number one priority over all liens, even IRS income tax liens. Property taxes always have number one priority. And the property tax is what's known as an ad valorem tax. Ad valorem means according to value. So the property tax is based on the value of the property. And there is what's known as an Affidavit of Value in Arizona, which informs the assessor that a property has sold and what the sales price was. So it is required that in order to record the deed, the buyer and seller have to sign the Affidavit of Value. And it mentions and states the sales price of the property. And as I've mentioned, it informs the county assessor that this property has sold at that price. If you're familiar with Zillow and other online evaluation programs, this Affidavit of Value is how Zillow and these other companies get their information. There are two values that you need to know about relating to property taxes. The first is the full cash value, and the second is the limited property value. First, the full cash value. This is the value that the county assessor determines annually for tax purposes. There's no maximum increase or decrease, no maximum change or minimum change in the full cash value from year to year. It's simply based on what's happening in the marketplace. Of course, if the owner doesn't like their full cash value, they probably feel it's too high, they can appeal to the county assessor. The limited property value is based on the full cash value, and it is the basis for all property taxes in Arizona. One of the important points about limited property value is that it may not exceed the full cash value. And the limited property value has a 5% maximum increase from year to year. So let's take an example using the 2018 full cash value and limited property value, and let's presume they're both exactly the same at $100,000 for 2018. So for 2019, let's say the assessor determines that the full cash value of the property is $110,000. So for 2019, the limited property value would only go up to $105,000 because the maximum increase that can take place with the limited property value from year to year is 5%. Let's presume now, instead of going up, that the full cash value for 2019 went down from $100,000 to $93,000. In that case, the limited property value would decrease to $93,000 as well, because the LPV cannot exceed the full cash value. The bottom line is that the limited property value cannot increase by more than 5% from year to year, whereas it can never exceed the full cash value. Let's take a look at the formula, the math formula for property taxation. We start with the limited property value and we multiply it by a state set number called the assessed value ratio or assessment rate. And that gives us the assessed value. From there, we multiply the assessed value by the tax rate, and that gives us the annual real estate taxes. Now, the assessed value ratios here in Arizona are set by state law, and they are 10% for owner-occupied residential property, as well as 10% for investment residential. In other words, houses that you might rent out or apartment buildings, they are assessed at 10% of the limited property value. Vacant land is assessed at 15% of the limited property value, and commercial property at 18%. And that includes office buildings, shopping centers, industrial property, and so on. The tax rate is determined by the local governments. So it's not until July or August that the county or the city get their budget acts together and establish the tax rate. Tax rates are stated either as so many dollars per $100 of assessed value or in mils. 1 mil is 1/1000th of a dollar, or 0.001 as a decimal. In Arizona, actually, we use the first. In other words, so many dollars per $100 of assessed value, but other states use millage. Let's take an example of an owner-occupied residence with a tax rate of $18 per $100 of assessed value. So first and foremost, let's presume the limited property value is $100,000, and the assessment rate or assessed value ratio, because this is a residence, is 10%. That gives us an assessed value of $10,000. Now we multiply the assessed value by the tax rate, which we just stated. The government told us was $18 per $100 of assessed value. That's 18%. So our taxes would be $1,800. Well, Happy New Year from the County Treasurer, folks, because now we're going to look at how taxes are levied. Taxes are levied for a calendar year in advance on January 1st. So as the new year turns, the taxes for the coming year are levied, become a lien against the property, even though we don't know what they're going to be. So what you want to keep in mind is the lien date for taxes is January 1. However, they are paid in arrears, and they're paid typically semi-annually because the government works on a fiscal year, typically July 1 through June 30th of any year. July 1 of 2018, for example, through June 30th of 2019. So, the taxes are paid, let's take an example here, January through December, the full year, but the first half, let's say it's $900, because the county doesn't get its budget act together until the early fall, the state law says that the first half of the taxes are due October 1st and delinquent November 1st. So if you don't pay your first half of taxes by November 1st, you'll get charged interest on those delinquent taxes, and the rate is 16%. The second half, let's presume it's $900 also for July 1st through December 31st of any year. That is not due and payable until March 1st of the following year and delinquent May 1st of the following year. Oh No More Money is an acronym which may help you remember the due and delinquent dates for taxes. O for October 1st, the due date for the first half, N for November, the delinquent date for the first half, M for March, the due date for the second half, and M for May, the delinquent date for the second half. Well, that's our look at real estate taxes. In another video, we're going to talk about delinquent taxes, tax liens, and tax foreclosures.